as a result of going beyond their understanding. And we don't want to just continue to do that, as we want to start from how the advanced class is supposed to be. Now, if I'm going to make myself clear, it's just like when you talk price analysis, when you begin to talk about price action. So a lot of times when you start talking about the price action and you start telling people about price action, um, it's really not going to go down well, because they find it very though it's going to be very interesting. They will see that that you have the stuff, and because you have the stuff, they will want to always pop in and see if they can get it. But most of the time, they didn't get anything. They will just go back, and when they trade, they will see that they have not been getting it right. So we want to adjust that. We want to start from where it ought to be started from. We want to put everything appropriately. We want to promote the idea that whatsoever we are doing, it's actually in the interest of the customers, the clients, so that every client can, every client can just make it clear. So, and that's going to be wonderful. So today, we want to take real time to, uh, uh, you know, want to take real time to go back a little bit step and retrace ways back to what uh, webinar is supposed to be. So this is exactly what we're going to do. Though actually it's advanced, and it's going to be what you are going to begin to do. It's very important that you trade and you make your fund, you make your profit, turnover on your investments. And as you do that, when you now get to know how you do it, it becomes very easy for you. So today, so I'm going to welcome everyone. I want to sincerely say that if you can hear what I am saying, please kindly say hi to me from the inner box there. Just go to the chat room and say hi. Then, then we can start the webinar. Okay. So please let's start. If you can hear me, please just say I in the webinar box so I can see that you can hear me. Then we just go on. Okay. So I'll be waiting. All right. Amadou, you are welcome. I just want to ask a brief question before we go into the class for today, and for the rest that are still listening. How many of us have been trading patterns, and you have been trading very well on your platform? So um, let's just know the quality of traders that we have online today. How many of you have been trading, and you have been trading, you know, you have been trading and profitably you have been trading? So let's just know what you have. Let's know the stuff. Okay. Okay. Ola, you're there. Hamilton, you are there. Adewale, you're there. Wale, you're there. And so how many of us have been trading and we've been trading fine? So let's know. Let's know. So what our experience is like. That's what I'm asking. Amod, are you can you hear me, please? Amod, can you hear me? Um, Ola, can you hear me? Adewale, are you there? Wale, are you there? So how many of us have been trading fine? So let's just give a typical analysis of what we've been doing, really. Okay, Ola, fine. And what about Amadou? Amadou, have you been trading? I'm waiting for your response because so that I will be able to know how to tailor my training today to suit whosoever is on the platform. All right, I'm still waiting. It's not it's just for us to be able to get to know everything appropriately. Okay, I'm waiting. I'm waiting. I'm on. Okay, I think Ahmad Emmanuel, you're not there. Okay, but let's just go further. Now, today we are going to concentrate majorly on whatsoever the um, whatsoever the case is. So we're going to concentrate on it, and we're going to move our plans forward. So we're like as I've said earlier, we're going to focus on retracing our steps back to um, how to make traders from scratch. And that's where we're going to go to today. So we're going to start from the real point where the professionals actually make a difference. And that is candlestick. If you look at it, we have candlestick patterns there. So that's where we're going to actually start from. Now, a lot of times that we have been having issues with trading, it's it's yeah, no problem, Ahmad. So that's exactly what we're doing today. We're actually going to build on that confidence. Okay, so now if you look at what has been going on, you will notice clearly well that a lot of times many things have gone wrong in trading skills and so many other areas like that. So, and it has proven to be one of the most dangerous parts of the trading that many people don't have confidence. Um, you know, they don't have confidence in what they trade. So, and that's why if we're going to actually make profit trading, then we should go back to the primary objectives, the real thing, and that's where this comes from. Okay, so now let's go through today's webinar, because I don't want to make it too long, so that we'll be able to understand, and we'll be able to ask our questions as we need it. Now, this is candlestick patterns. Every trader should know all that is going to be on this webinar. Now, as you can see that on this screen, on your screen now, what you'll be viewing is the candlestick, two different types of candlestick. Now, those two different types of candlesticks, they're actually delineating the major differences between a bearish candle that is actually going down, and the candle that is actually coming back up. So we simply mean that if you're going to trade, you will need to have some basic understanding that, okay, the candlestick has patterns. The candlestick has patterns. And the patterns that candlestick has, it's the pattern that actually makes it worthwhile in trade. And because of that, it becomes very, very important that everybody now have major understanding of what the candlestick is all about. So now the patterns will determine what you're going to be doing in the market, because it is what the pattern now showed you, that is what will now generate your trading skills. So today we are going to confirm to the patterns of the candlestick. So now looking at the patterns, now let's look at how it is properly labeled. You can see we have the high, the same thing. You can see even the bearish candle. This candle you're looking at is the candle that is going upward, and this candle that you're looking at is the candle that is coming down. So now in other words, what we're looking at here is typically the movement of price. When price is going up, this candle will delineate it that price is actually going up. That's why you have high. This stick-like, stick-like thing that you're looking at here is called the shadow. It's called shadow everywhere, but there's a difference there. Up here is called close. Why up here is called open? Why? The reason is when candle opens from down and the price is actually surging, the candle opens there, it will close up. But if it's the price that is dropping, if it is the price that is dropping, you will notice that you have price opening up and closing down. Okay, so which makes it bearish and bullish. Okay, so now let's go ahead. Now the entire trade resides in this big body. The same thing happens to this too. While the downside of a bullish candle is called the open, and for the bearish candle is called the close. Lower shadow, which is as well as the same thing you have here, and the edge part of this is called low. So which means you have low and high and low is the same thing. It points to the same direction. So when it is like this, it's high and low. When it is like this, it's high and low. But the only difference is that where do they open? Where do they close? So if that will be your go-to, then you should be able to make advantage of what the chart is presenting to you. So if I were you and you and me, I'll take advantage of that. Then I would say that this is what the market is doing and this is what I'm going to do. So now that is exactly what market it's all about. So now if you look at the point I'm trying to raise here, the point I'm trying to raise here is that market has patterns. And because market has patterns, there is nothing you can do than for you to follow the patterns. Now, I'm going to show you all these, all these structures of candlestick. Candlestick begin to form as a result of trading is going on. As candlestick begin to form, then it forms different patterns. So it formed different patterns, and because it formed different patterns, then it gives a lot of impression to all traders, so that you'll be able to know that this is what is happening in the market. Sometimes the candle will squeeze, sometimes the candle will form big, sometimes the candle will form different forms. So those forms actually decide when market will, what is happening in the markets. And that's also inform you on how to trade. Now, if you look at this white candle, you look at this black candle, they delineate different, directions of the market. For the white candle, it's going up. For the black candle, it's coming down. We have this candle they call doji. In fact, we have types of them, 4 types of them. We have doji, we have the long leg doji, we have the dragonfly doji, we have the gravestone doji. So these 4, they are all. There's another one that looks like a dash, and that one is also a doji. It's just like a dash like this. So this has a long lower shadow, but a smaller upper shadow. Possibly it can be termed as an armor, but but because of the peculiarity here, we will see an hammer. Of course, we will see an armor in this explanation. And this one has a lower shadow, a lower shadow, and a long upper shadow. So which means candle form this direction. So you can see how candle forms, not only one pattern. Now this is an hammer. When the wick is like ×2 of the body, then if you look at this, this is an inverted hammer, which simply mean the longer shadow upward is ×2 the body. Okay, then we have spinning tops. Spinning tops when the body is very small, the trading body is very small, but the wick are longer than the body. Okay, the same thing happens. Remember, we have a black doji, a black spinning top, or a white spinning tops. So because we have that, it becomes very, very key for you to understand. We have what we call Mariposa. The Mariposa is a complete trading option where the one side of the trader dominates the market completely. So these are ways that candle forms. It forms in this pattern, not because of any other thing, just because of the reaction of trades. That's what trades actually react to. So, and as a result of that, it becomes very important for every trader that they should understand that this is what the market is doing at this point in time, at this time, and that the market is going to do. If the market is doing that, it will react to show you that this is what will likely happen in the market. So for you that you're just coming to understand this, these are your go-to. This is what you have to memorize. This is what you have to be looking at. So when you look at some of these things, then it begins to show you the direction of what the market will be doing. So we are going to now consider some of these, formations that you are seeing on your screen. We're going to consider them, and as we consider them, then we will now look at how they form, what pattern they form, then what's their usefulness when they form such pattern. So let's go to the meeting, to this next slide. Now, what is doji? A doji represents an equilibrium between um, supply and demand. Simply means that a tug of war, a competition of war, that neither the bulls nor bears are winning. So it means that a lot of times that when you see doji, what he's trying to say is that the buyer and seller, they are dragging for winner. So at the end of the day, actually one person will win, but eventually it will, it will just show you what is happening in the market, that there is indecision in the market. Now let's take an example and see what a doji looks like in the market. Okay. Now, if you come to this side, you will notice that this is a doji. It's a doji in the market. It's circled for you. In this case, the uptrend is winning. You can see eventually it shows that the uptrend is winning. The bull have been defined by definition. Previous battle, they have won it because price have moved higher. But what actually gave that formation before they move higher? Look at it. As price was actually coming down, it got to a point here. It began to form spinning tops, form doji. See that? See the reversal, and they just move by it. Now, more so, if you come here, you will see another one that looks very much like this. They have been moving higher, and all of a sudden, you see that doji formed, price reversed down immediately. So, at the peak of every price, you begin to see that price have been moving on, but all of a sudden you begin to see small trades. Then you see spinning tops. It means that price is actually willing to reverse. And when it reverses like that, this formation actually defines what, how it reverses. Let's go to the next one. We call one an hanging man. The hanging man occurs because traders seeing a sell off in the shares rush in to grab the stocks a bargain price, just because they notice that the stock becomes very low in price, so they're just going to buy to make profit. In order for this hanging man to become very valid, the following conditions must exist. Number one, the stock must have been in a definite uptrend or uptrend before this signal occurs. This this can be visualized. This is visualized when you look at charts. I'm going to show you a chart that is going to explain that in a while. Now, the lower shadow must be at least twice the size of the body. The day after the hanging man is formed, one should witness continued sell-off. So, and the final part of it is that there should be no upper shadow, or a very small upper shadow is expected. So the color of the body does not really matter in this case. So maybe it is white or black. Once it forms and you can see there is struggle in the trade, then it simply means that the market is actually struggling to overcome whatsoever is battling is in the market. So now with this, one should be able to say, okay, this is what is going on. This is how I'm going to do it. And, at the end of the day, you just notice that you'll be able to just prevail in some of this market because you now can interpret what is going on in the market. Now, hanging man can only be found on the top of an up movement. It cannot be found downward. If it is found down the down move, the downtrend, it is no longer an hanging man, it is an armor. But since we are dealing with an hanging man now, let's look at a chart to define it. The hanging man. If you look at the price have been going up, you know, been going up. At a point in time here, you see an hanging man formed. When this hanging man formed, the day after that, because this should be apparently a daily time frame, the next day the price begins to drop from there. You can see how perfect price delivery this would be. So when you see something like hanging man, and the point is at the top of a trend, then it should send a signal to you that a possible reversal may occur. A lot of people will want to allow you to break structure before they trade it, but notwithstanding, it's okay if you will wait for confirmation. And how do you wait for the confirmation? Let me just show you. Look at this place. There is a swing low here. This candle, if you look at this candle, there's a swing low here. A lot of people will be waiting for it to be broken. This candle that made the hanging man, the bottom of it, you can see when this one came, there was a struggle also, like an equal low. It didn't break, but when it broke it here, okay, then you can take your buy or sell, sorry, on this trade. At the close of it, the next day, you're going to sell. So that's how that part is taken. So hanging man is a very effective one, knowing for sure that this is candlestick pattern. Now, if you come to the next slide, you will see that we have hammer. They pretty much look like look at hanging man. This is hanging man. They pretty much look the same, but where you find them matters. It is the place you find them that's now, that will now determine what your trade will look like. If you find it somewhere very interesting, then you will be able to take advantage of it. But if you find it somewhere, maybe in the middle of a ranging market, you don't do that. Because if you do that, if you take it, you are not trading according to trading plan. So as a result of this, then there's as a result of this, you have to know when to take this trade. Now, understanding hammer, hanging man, like as hanging man is found on the top of a moving trend upward. But hammer put in its appearance after prolonged downtrend. On the day of the hammer, the candle, on the day of hammer candle, there is a strong selling. So then often bargaining at the opening bell. In this case, the market potentially is hammering out a bottom. Possibly, they want to change the direction of the market. So, in other words, the same procedure will be will be considered. Number one, the stock must have been in a definite downtrend before this signal occurs. This can be visually seen on a chart. You can see it as I showed the other time, and other conditions that's applicable for hanging man is also applicable for it. But let's look at the chart and see what we're saying. If you notice something here, you will notice that if you notice from where it was actually coming from, it was actually coming from here. So now, but if you wonder what happened at this point, the price made it low, but it didn't make that complete low before it came to raid all the levels here and form what we call an hammer. Now, when it formed this hammer, it's actually telling you that it's hammering out all these lows that have been coming. Then the price move on and begin to exhale up high. So this simply means that you're trying to look at the complete configuration of what the price would look like and how the price will be moving. Because if you don't consider how your price moves, if you don't consider what is happening to the candlesticks, you may not eventually enjoy taking an appropriate move. So it is very, very key that you take an appropriate move, you understand the appropriate moves, then you also try to enjoy the benefits by the time you have taken right decisions. So now, when the price was coming, that it was actually coming down, I cut the chart so that I can show you this. So it's actually coming down. It first came down, then later it raided and formed this hammer. You will notice that while it was doing all that before, it didn't form any hammer. And if you look at all through, you won't see any hammer. So which simply mean that when price formed down like this and formed hammer below and form hammer, then automatically you should be expecting a buy off from that point, because hammer will hammer out the hammer simply mean that it will take out, it is taking out the sellers from the market because there are buyers. Now, let me show you what it means. This candle was as full as one of these. It was full all through. But the buyers came into the market and pushed the price up and it closed here. So the entire profit of the sellers that same day was minimized. So which simply mean that this is to show you that there is a strength in this market. Eventually, the buyer stepped into the market, pushed the price further, and you can see they struggle, but there was no more seller to push it down. That was why the buyers began to win. So, and this is just to analyze to you that this market can easily be, you know, can easily be confirmed by different analysis, which helps you to be able to take advantage of whatsoever is going on in the market. So now, if that's the case, let's go and see the next slide. As I said, this is the reason why um, many of us will want to go back to our drawing board and trade. What did you see before you take the trade? Did you just take the trade just based on momentum? Price is dropping, price is dropping. Is it true that the price is dropping? Are you going to follow it or not? So as a result of that, you don't want to just go into the market just like that. So now let's look at this very well. We have engulfer, an engulfing candle, but we have two types of it. We have the bullish engulfing, or we have the bearish engulfing. As in the case of hammer, you don't have two types of hammer that can change position, but hammer has only one, except for inverted hammer. So now, a bullish engulfing candle simply means that there was an existing candle that a new candle formed to engulf it. So, which means that it's formed beside it and is bigger than that candle which formed before. So, which means it's swallowing up the complete formation of the candle. So, the example here. Now, the example here is that you can see this small black candle. When this white candle will form, taking power from this, all the profit that this has got, you just notice that this in this candle it was swallowed to the point that they would have been in loss as a result of this. So this simply means that it occurs in a downtrend. That's a bullish engulfing. A bullish engulfing signals buy, and that's why it occurs in a downtrend. Why we have um, the bearish to occur in an uptrend. So the stock must have been in a definite downtrend before this signal occurs. This can be visually seen on the chart. The second day of the signal should be a white candle opening. Normally, it depends below the close of the previous day and closing above uh, open of the previous day back candle. So we simply mean that we're expecting that if this candle was a down move, then the other move would be for the engulfer. So if you look at the down candle, the black down candle, you will notice that this down candle is signaling that the bearish move is still continuing, but the white candle came up, swallowing up the down candle, showing that it's not going to go down. Now let's take an example. Let's take a look at a chart and see how it happened. The price was actually going up at a point, but dropping. So as it was dropping, look at this downside. You just notice something, that the price engulfed this one. It engulfed it. It's supposed to continue to go down even after it has taken out this. But you see this candle, this white candle, traded above it, and traded above it heavily like that. Some people wouldn't have chosen this as an engulfer, but this is an engulfer. So because look at the way this candle traded above it. If you go to lower time frame, you will notice that the candle was real. So which simply mean that the candle has been engulfed. Now that also signals volatility in the market. So you can see what happened after that time. 3 other candle forms after it, and you can see where they landed themselves. So this is just to make you clear that we have signals from candlestick. If only those 3. I'm not going to remember. I'm going to dig deep into candlestick patterns. So I'm going not only in this video. From ends, I'm going to make sure that price action we're going to be studying will be based on candlestick, so that we'll discuss all the candlestick pattern, and you'll be able to take an advantage of whatsoever you want to take an advantage of. But for this webinar, I'm going to keep it short. Now look at the next slide. As we have bullish candlestick pattern, so we also have bearish candlestick pattern. Now, if you consider the bearish candlestick pattern, is the same thing, pretty much the same thing. It signals its own when it's in an up movement. You need to just check around and see the instruction by looking at the stock markets must have been in a downtrend. In a downtrend before this signal occur. Sorry, in an uptrend before the signal occur. Because when a bearish pattern simply means that it's going down. So, and the second day of it should form, sorry, there's a mix up there. It's supposed to be bearish, not bullish. So, so it's supposed to have been in an up move. Of course, I'm going to show you the sample. So then it's supposed to be an up move. So really sorry about that. Really, really sorry about that. Okay, really sorry about that. So it's going to be corrected. So I just correct it later. But okay, now let's look at it. Let's look at the formation and see how it will form. Now this must have been in an uptrend. See as price is going up. This is the last up candle. See that up candle, that white candle. All of a sudden, see this down candle engulfed it just like that. And it so engulfed it and engulfed it. In some cases, the price will be retested, like this price coming back into it, retested, giving you another opportunity to be able to sell short. Now, when this happened on this candle, some people would have sold short, okay? But it created another opportunity for you, to retest it here, and then you short it again from there. Look at another opportunity, short it again from there. Look at another opportunity, returning back, short it from there, and see this also, another opportunity, shorting it from there. So it simply means that in the candlestick pattern, you have a whole lot of opportunity to take advantage of. So if you take advantage of some of these things, it will give you a better option, a better trade, and you will be able to consider a lot of opportunities that you you have trading on the platform. So I don't, like I said, that this webinar is based on going back to check up with what people have been looking at. And so let's take an example of a current trade on our platform, and see the possible of use of this. So if you will follow me to look at it. Okay, let me just let me just open it, and let's see a current rate, and see how it's moving. So now with this, I'm going to take advantage of the Eagle Global Market, the platform on MT4. You can see the screen. I'm just using this. See the RSI, see the bottoming below this. I think everybody can see. Okay, good. I'm going to make it big so that you can see it well. Okay, all right. Okay, see the RSI here. Can you see that? See the bottom in there, and see this candle. Okay, see that? That's an engulfing candle. Remember that this is not just a 1 hour time frame. This is a daily time frame. So see that small candle. See how it's engulfed there. After that, see what has happened so far. If you are to buy, you buy from the next candle. So now it's well over 400 points. So, and if you just want to follow it stylishly before, after it has formed the second day, would have given you still the same pip. Now, see the rally is going on. See this another engulfing. I was expecting, I put that line there. I was expecting a rally from there. So see that engulfing. Now, see what happened. The price just moved. Where is this price going? It's actually going to fill in this price level. So that's where it's going. Okay, perfect. That's where it's going. So it's actually going to fill that point that was not initially balanced. So from where it is now to that point, that's about 97 points. So this is pretty this is wonderful, and that is exactly what candlestick can show you and can do for you. If you just look at it, you will get it. Now I want you to also see more other opportunities in the market. See GBP USD. It has done mightily today. Come and see daily. If you see daily, see. Let me just remove some of these things. It's too much. It's too much there. Now, if you look at this, see this downside candle, this black one. It has been coming. See that RSI, it bottomed. See what happened. See that candle, perfect price delivery. After that, the next candle, if you had bought from it, okay, your stop loss will be below that candle that was initially engulfed. Let me make it clear to you. See it here. Your stop loss would have been under it, so you're not going to be afraid. At least maybe 20 pips below. Let me just make it clear. Maybe 20 pips below it. Then as it has engulfed, you know, you bought from the next candle. All this merry-go-rounding the first day, the second day, but it didn't go to your stop. Then look at what happened to you. Price, a perfect price delivery. And we'll look at what happened to you. This is about 858 pips on daily time frame. That's what we call swing trades. But if you leave it further, you have 1,200 1,027 pips. Just multiply it times $10. That's about $10,000. So you can imagine this is a pretty much profit for you. So if you go around and you move around, even in gold, you will see there a lot of them. See that candle, that down candle. Okay, see how price, engulf it, makes it clear. Some people won't have taken this trade. Okay, even if you don't take this trade, come to today's trade. Today's trade, see this candle, see this last down candle. It took out all these lows as if it's coming down. You may not see it well on this time frame, but look at here. Price engulfed that candle. See that? As price returned to that same candle, You know, the next candle, we said you are going to buy from the next candle. If you had bought from this next candle, now you are in the trade currently. Where is this price going to? If you are in the trade, where is it going to? Now, look at the liquidity above these two candles. Look at this one, this. Okay, so where is the price heading to? It's actually heading to heading above 1745. So that's where price is actually heading to. But you know, there's going to be a retest on this level and price, and that's from here to that place about 400 points. From here to that place is about 400. But if you are taking it, you must be ready to risk about 100 pips. So from here to that place, about 400 points. So that's a wonderful price delivery. It depends on the kind of trade you trade. If you call it, it depends on what you trade. If you trade on, you know, if you trade on, so sorry about that. It's the network. Is something cutting off the network. So if you trade a long time, which we call swing trade, your stop loss should be below this. Expecting, okay. Remember that at least it's supposed to be below this. We're still expecting a retest, really, a very perfect price delivery there. So your stop loss should be below this level, and you're expecting a move higher. There's a lot of liquidity high here, and as we speak, dollar is very weak, very weak. So Safe Haven is been very happy, so that they can jump higher. And you know, when they jump higher like that, it's a big profit. So it's from that point, this opening to that place about 400 points. So if you can be patient and you wait to take this trade, you may not see how perfect this price is now, but if I show you in a lower time frame, you will appreciate it. Just let's look at 15 minutes and let's see how price delivery. You can see. Okay, this says 15 minutes. Let me just reduce the size. Okay, all right. Let's go to 1 hour. Let me go to 1 hour. Okay, so now this is where your stop loss is supposed to be. Now let's go to daily and put our line where we're expecting to buy from. So if you are buying, you're expected to buy from that point. So if you go to 1 hour, okay, this is where you're expected to buy from, somewhere here. Apparently, it may go a little bit low, but we're not sure it's going to go down here. So now, where are we expecting the price to go to? See that? If it comes down here, you can merry-go-round, you know, and jump up again and, you know, hit your target. So that's exactly what engulfing candle can do. All you need first is just to be able to look at what your perfect price delivery is all about, and it helps you to be able to take advantage of the market. Okay, Sam. Now I can entertain question. I'm already rounding up. All right. Is candlestick reading strategy same as price action? Perfect. Perfect. The first thing you should understand that the candlestick is one of the main indicator. That is an indicator. It's a price indicator that helps you to be able to take advantage of the market, and it's one of the analytical tools. So it's used perfectly to read price action. That's it, because candlestick is basically price action. All right. The second question you asked there. Anybody can ask question now. So please go ahead with your question. The second question now is that does the size, which is the length of the wick of the candle, same as the volatility? Now, this is exactly what I've been hearing a lot of people asking. So let me explain something to you. You see the wicks here, that these simple wicks that you're looking at, these wicks, it's telling you that there was high volatility in the market. Now, the high volatility in the market now constrains a lot of people to take this, to take the probability that the volatility will be, the volatility will drive the market down was not so sure. So, but there was high volatility, so price came down to this point. So as a result of price coming down to this point, but price did not stay there. Look at where price closed. So all these legs are volatilities. So you want to take advantage of that. You want to read that as part of your price. Sometimes some people say they will not take it. I tell you, if you don't take this week very serious and seriously, you may lose a lot of markets. You may lose a lot of markets. So that's it. Okay. So let me finish your question there. Is it better to place a trade based on candlestick pattern than indicators? In fact, I will want to say something very clear there. You have just answered your question. When you are trading with candlestick pattern, let me just clear it there, clarify it there. You are trading with the knowledge of the price action. You're trading with the knowledge of the price action. So which is very, very important for you to know. You're trading with the knowledge of the price action. So there is no indicator that can tell you exactly what the price is doing, but candlestick can tell you. So it's better to trade with candlestick, okay? But if you have any other indicator that can also support you, you can go ahead and do that. It will also help you, okay? I'm answering all your questions. So I've answered all your questions, except if you still have other questions to so that is it. Okay, except if you have any other question. Okay, please, I'm waiting for your questions.